I want to talk to you about P2P versus bank loans. And if you're thinking about peer-to-peer lending, you got to really ask yourself if you've got actually a better approach to actually getting loans than actually going to a bank or a credit union, okay, or even an online lender for that matter. Let me first, before I do the comparison, I want to quickly define for you what peer-to-peer lending is and what is not, right? Because there has been some confusion in the public in terms of what peer-to-peer really lending really is. So if you think about peer-to-peer lending, you are speaking about an alternative way to access financing, okay? Because there are some, I would say, borrower profiles that banks and credit unions do not want to finance. They're right. They have their own right to choose whom to do business with or not. Okay. So basically, with P2P lending, investors, both individuals and companies, are actually paired directly with those who need to borrow money. Okay. So this is something that's pretty direct, very, very flexible. So unlike traditional loans that come from places like banks, credit unions, or online lenders, peer-to-peer lending allows you to borrow money from an individual or company who wants to invest in you and your loan. So because individuals and companies who are not licensed bankers, they don't really have the same risk mitigation. I would say the risk factors the banks and credit unions look at. Okay. Now, one thing I want to say here is that the investors themselves would collect the interest and fees a borrower will normally pay to a traditional lender. So by cutting out that middleman, investors can receive a larger return on their investment, though they are taking on additional risk and additional risk of losing money and not getting repaid, right, if the borrower default. So how does peer-to-peer lending work? Well, you have a platform. Okay, you have a platform that allows you to pre-qualify. In other words, you get a soft pool to see how much you could qualify for. You apply. Okay, you assess your risk. You want to see basically if the investor thinks that your risk is actually pretty reasonable, and you have approval and matching. So the platform will match you based on the investor risk tolerance, and you get funded, and then you repay the loan. So it's pretty straightforward. So when you think about peer-to-peer loans versus bank loans, let me talk to you about what you can use a peer-to-peer loan for. One thing I can tell you is that there are no restrictions. There are, I would say, largely no restrictions when it comes to peer-to-peer loans. Okay, pretty flexible. There are no strict requirements because those lenders, those investors, they're not professional lenders. Okay, so their regulation is a little different. So you can use a peer-to-peer loan for medical bills, for home improvements, for household purchases. So if you have something to fix in the house and a bank doesn't want to lend to you, or a credit union, you can go to a peer-to-peer loan, a peer-to-peer lender. Funding a wedding, vacation, or other large events, or car repairs, emergency or unexpected expenses. So you have lots of possibilities when it comes to getting funded. Okay. And so when it comes to peer-to-peer lending, you have to really understand that you can actually use the loan for just about anything, right? You also have a fast application, approval, and funding times. You have fast application, approval, and funding times in the sense that you can be funded within 24 hours. As long as investors love your profile, your borrower profile, because investors are not just looking for FICO score. Of course, your FICO score will establish a certain likelihood of you paying your loan. That's for sure. But investors also want to look at your fundability. In other words, you're making revenue. You have a job or you have a business. You have something coming in every single month. So that's why you have a fast application time. You have a fast approval time and also funding time. Again, it can happen. Everything can happen from application to funding within 24 hours. But usually it's more 72 hours, okay? You have more flexibility with the application criteria. You have a very easy application process, and you can get pre-qualified for more personal estimates. So that's actually a little bit of the pros when it comes to P2P lending. On the flip side, you do have higher interest rates. You have fees. not many protections for borrowers if you have difficulties repaying the loan, okay? And you have a lender that is, you don't have not as much customer support for the borrower because this is just a platform. A peer-to-peer lending platform is just a platform. They don't take any risk, okay? They just created a platform to match borrowers with investors. So now you kind of have an idea about what a peer-to-peer loan really is. Let's talk about a bank loan now. You probably have more information about bank loans than anybody else, okay? Than everybody else because bank loans are pretty straightforward. They're pretty mainstream, okay? So a bank loan is simply a personal loan you get from a bank versus a credit union or online lender, okay? So I'm talking about you getting a loan from Truist, from BMO Harris, from Fifth Third Bank, from PNC, from US Bank, from Wells Fargo. When it comes to bank loans, by the way, the maximum you can have is $100,000, and that comes only from one bank as of date of this show, and that's actually Wells Fargo. Wells Fargo can give you a maximum of $100,000. If you want to actually expand your most bank loans are around 50K, 35,000 all the way to 50K. So if you go to a Truist Bank or you go to a BMO Harris or you go to a US Bank or a PNC or even Citi is giving you 30 grand. Okay, but usually it's around 30 to 25 to 50K. If you want 100K, you have to think about online lenders, also credit unions. So you have a Connexus Credit Union, CCU. You have also a SoFi and also Lightstream, which are the other three that give you a maximum of $100,000. Okay, so banks will really work with you if you are an existing customer. Okay, so but if you're not an existing customer, you want to really first start. You want to first start building a relationship with them before applying. Okay, so when you apply, the bank will review your credit score and history, income, and other factors to determine whether you qualify for the loan and what your APR will be. If approved, the bank will fund the loan and you'll repay the bank in fixed monthly payments. Okay. So if you want to really get a loan from a bank, like I said, start first building a relationship with the bank. Take steps also to improve your credit score and history because banks are pretty strict when it comes to their criteria for approval, and they're not going to really change that just because of you. Okay. So make sure that you actually beef up your credit score a little bit and find a bank that offers a secured loans, which means you would have an assets as collateral to the loan. That way you are increasing your chances of approval, and also find a bank that offers co-signed loans. That way you can apply with your spouse, your brother, your sister, your a family member, a friend, a colleague. Okay, especially if you have bad credit. So when it comes to bank loans, the use of loan proceeds is a little it's not strict per se, but it's pretty much regulated. Okay, so if you think about what you can use a bank loan for, it's kind of similar to what you can use a P2P loan for. However, lenders actually every bank has its own, I would say, criteria. Some banks will allow you to use the funds for something, and others, like for instance, a lot of banks don't want you to use their loans to fund your education. If you want to fund your education, go get a student loan, okay? And so that's really important. Or just to use their loan to buy maybe a vehicle, for instance. They want you to get a car loan, okay? So this is important, but by and large, there are no exceptions when it comes to the use of loan proceeds for bank loans. For instance, you can use a bank loan to fund a large trip or event, for home improvements projects, for debt consolidation, car repairs, medical bills, emergency expenses. You can even use the cash to for moving expenses and so on and so forth. Okay, just make sure that you check with specific lenders to see what they have in store for you, for borrowers. So, what are the pros and cons here? If you think about bank loans, for instance, you got to really ask yourself what works for you and what doesn't work. So, a bank loan can be used for just about anything. Again, every lender is different, okay? And you have in-person and virtual customer service and support, including applications. That's a cool thing. If you were to think about P2P loans, for instance, you can't go to a physical branch and sit down with a rep. But banks, especially large banks such as a Wells Fargo or US Bank or TD Bank or Key Bank, they do have a network of brick and mortar branches where you can really talk to a live person. Okay. And there are no origination fees. You have low minimum APRs and you have larger loan amounts, sometimes up to $100,000. Like I said, in the case of Wells Fargo. Okay. On the flip side, you do have higher interest rates, other fees, higher credit score and other borrower requirements, high maximum APR, and slower approval and funding process. So if you think about peer-to-peer lending versus a bank loan, what's the difference here? I mean, how do you play the game to actually make sure you come out actually a winner? The primary difference between peer-to-peer lending and a bank loan is where you get the funds, right? Banks will fund the loan themselves. A bank will fund the loan itself, right? It will use its own resources to fund the loans. But when you go to a P2P loan, the money comes from an individual or a company lender through a web-based platform, okay? And the individual or company can choose to fund some or all the loan. Like if you ask for 50K, they might say, well, you know what? We're not really, we don't have 50K, or we don't want to fund 50K for such a borrower profile. We'll fund maybe 25K or 30K. So that's really, you have to understand. And then what happens is that you repay the platform, who then distributes the repayments to the lender or lenders, okay? With the bank loan, you work directly with the bank to receive funding and repay the loan. So it's pretty much more, it's pretty straightforward, okay? So now there are a few other differences that you really need to keep in mind. So in terms of qualifications, banks typically have stricter borrower and credit requirements. P2P lenders, things are more flexible. Okay, you have more flexible application criteria and requirements. Like I told you, they don't just look at your credit score. They look at your income. They look at your employment potential, your degree, for instance. Okay. In terms of customer support, you don't have a customer support with P2P lenders. The platform doesn't invest in that sort of back office work. Okay. Whereas with the bank, you have online customer support, in-person customer support, or even phone support. You have protection for borrowers, especially those who are existing customers. In terms of the funding timing, with P2P lenders, you are really in luck because you have fast application approval and funding times. Whereas with banks, you might wait even all the way to 2 weeks just to get funded, okay? So things are not just as fast as possible. The application process, you have a very easy application process online. Everything is done online with P2P lenders. With banks, you can do the application online, over the phone, in-app, or in person. And the loan proceeds can be used for just about anything in both cases, for banks, but also P2P lenders. And also the loan amounts actually depends. With P2P lenders, you might be capped at about 50K, okay, because everything depends on the amount the investors want to finance. But with banks, you can go all the way to $100,000, okay? So the bottom line is that P2P lenders offer personal loans as other financial institutions do, but they try to cut out the middleman and connect you directly with an investor, okay, who will financially back your loan, unlike working directly with the bank. So that's really important to understand. So let's talk about peer-to-peer lending. Is it really worth it this year? Let's quickly have a conversation about that. Okay, so one thing you need to really understand here is that when it comes to peer-to-peer lending, we're talking about flexibility, that's for sure, right? We're talking about also accessibility, and we're talking about speed. Those are things you really pay attention to. So there are some cases where, for you, a P2P loan could be really interesting. Okay, you just have to make sure that you have the right sort of the right profile, because you want to go with a P2P loan if, for instance, you want a loan option with less strict borrower requirements. You only need a small amount of funding, though loan amounts can vary, can go all the way to $50,000. If you want also a fast application and funding process, you can also think about a P2P loan, because you can be funded within 24 hours. Okay. And sorry about that. If you are, let's say, okay with an online only application and customer support process, you will find actually a P2P loan process also interesting. Okay, from that point of view. And also, one thing I want to say here is that if you don't need much support in terms of customer service, like some borrowers are pretty fine to not even talk to customer support. Like they just want to get the funds and that's it. So if you are in that category, if you don't need to talk to someone over the phone, either during the application or after the approval, you are pretty good. Okay. I mean, the best advantage to P2P loans is that you may get better interest rates than other financial institutions, especially if you have a great credit score. Okay. Because they're cutting out a lot of middleman activity. So that's actually a cost savings for the borrowers, right? That's an important element to really think about this year. So basically, when you think about peer-to-peer loans versus bank loans, you got to really ask yourself if peer-to-peer lending is actually safe. One thing for sure, I can tell you they are safe. Okay, they are definitely safe, not a problem. So if you think about what happens here is that you have regulations actually controlling everything on those platforms. Okay, so lending platforms for peer-to-peer loans are safe to use. Not only do they protect and guard your personal and financial information, just as a traditional bank or a financial institution would. Remember that investors are taking on the most risk, because if you as a borrower you don't repay the loan, the investor likely won't get his or her money back, right? So this is something to really think about. Now, basically, can you get peer-to-peer lending at banks? No. No. While banks do offer personal loan options, they do not offer peer-to-peer lending. So this is something to really think about, okay? And it all depends on what you want from the loan process, actually. Would you want to talk to someone live? Do you want to go to a branch? All that kind of stuff, okay? And peer-to-peer lending is actually pretty cool because they don't affect your credit score right away, okay? Because you go through a pre-qualification process, a soft pull process. You only actually go through a hard pull process when you sign a contract, when you actually give them authorization to actually go ahead and give you go through the actual loan process. Once you're happy with the numbers they give you through the pre-qualification, you then release them from checking your credit score for real. That's that, and at that time it's a hard pull, and then that's the only time when you actually get your credit score checked. Okay. So long story short, when you think about peer-to-peer versus bank loans, which one is better? The answer is not really that difficult. Everything depends on your individual needs, preferences, and qualifications, okay? What you want to do is you want to research all your options to determine which type of funding is actually right for you this year. So in conclusion to this conversation, I spoke to you about peer-to-peer versus bank loans. I explained what is peer-to-peer lending, what is a bank loan, and if P2P loans are worth it. And finally, which one should you go for? Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.